So let's begin with the big issue, the Fed showing no signs of stepping in.
They're going to remain patient.
Patient is the word they use.
As they wait for economic effects of trade tensions just show up.
The market really assumed that rates might be coming down.
Expectations for rate cuts.
Much more significantly than they thought a month ago because of these trade and technology tensions.
Driven by this concern about geopolitical risk.
When we look at these minutes,
the minutes were documented for a meeting that happened before the escalation.
These were against a backdrop where trade wars hadn't revived their ugly head.
After what we've seen over the last 2 weeks, I would say that becomes a lot more balanced.
The development depends on the juncture that we get from this trade policy, but that's, to us, not an obvious call.
Let's continue the conversation. Joining me around the table, Oksana Aronov of JPMorgan Asset Management, Kevin Giddis of Raymond James, Gina Adams of Bloomberg Intelligence. Oksana, let's begin with you. What breaks the patience over at the FOMC?
There's really no reason for them to not be patient at this point because nothing in the data is really forcing their hand. And also, let's remember, there's a lot of conversation about inflation and is the Phillips curve no longer a good indicator, et cetera, et cetera. But the reality is that the Phillips curve still remains very much the connective tissue between the two, the dual mandate of the Fed. And so investors should realize that irrespective of whether the unemployment inflation relationship holds or not, it is still something that the Fed absolutely will observe, and neither one of those is at this point really causing the Fed to move one way or another.
Gina?
Well, I think that right now is a very tenuous time in a lot of ways because nobody knows what's going to happen with trade, right? At least for the month of June, what we know is, okay, we're getting a deterioration in trade relations that was basically expected as of January, so we can have sort of this modest reaction. But through the course of June, you can envision a scenario where either things get materially worse or they start to get better, and nobody knows how to handicap the prospects for that. And frankly, all we know from the Fed was their opinion prior to all the trade tensions coming up. So when you think about these minutes that were released yesterday, that was a meeting that they had before Trump started tweeting about trade, before we started this trade tension, so to speak. So I think there's just a lot of uncertainty in the market at the time when there's an air pocket in data, right? Equities love earnings seasons. There's a lot to absorb. There's a lot of guidance. We're out of earnings season. There's not a lot of meaty economic data to come in the next week or two. So we have to focus on policy, and that's an uncomfortable environment.
Any reason to believe the view of the Fed has changed, though? Even though those minutes predate the trade story, Kevin, I don't see anything from the latest communication that says anything's changed.
No, I think the Fed likes where they are right now, and so I think they'll plan to stay there until their hand is almost forced, which may be later in the year. Just depends on the data. We would have to have a kind of a blowout to the downside right now to get the Fed off of where they are, and I don't expect that to happen.